welcome to Money Managers, a User's Guide. I'm Nathan Peters. As the war in Ukraine sadly seems to be heading into an attritional phase, I've been struggling with an understanding of what assets investors can be long that will preserve wealth. Most of the traditional asset classes people have exposure to, bonds, equities, credit, and cash, all have proven issues in stagflationary environments. We can see this playing out in real time with typical 60-40 portfolios, the default for many investment programs where a 60% allocation to equities is paired with a 40% allocation to bonds, which is meant to lower the volatility of equities. Vanguard's version, mutual fund ticker VBIAX, is currently in its largest drawdown since March of 2020 at over minus 10% as bonds have sold off with equities. This is the 7th worst drawdown since inception in 1995, and only 2 drawdowns starting in 2000 and 2007 respectively lasted longer than 3 months. A charm for sure, and the reason for its dominance over the investment landscape. A 27-year track record of over 8% compounded annually with a 0.6 Sharpe. Yes, please. That's inflation plus over 9%, something that may take a bit of doing now with inflation at 8% itself. When was the last time markets rhymed with the current scenario? Research points to 1973 to 1974. Granted, the US economy looked very different and was much more susceptible to inflationary forces due to a greater emphasis on manufacturing and collective bargaining on the labor side. But the results of inflation in the teens were bonds down 12% and equities down 40% over that period. If I plug those numbers into Venn's expected return forecasts, the current factor exposure of a given investment will be set against those expectations. If we take the current 60-40 portfolio exemplified by VBIAX, its expected returns falls to minus 11% annually, the diametric opposite of most people's lived experience. So what can we do? Well, 2 weeks ago we dived into commodities, link in the description below, sole asset class that does well in a 1973 to 1974 scenario. For most people, the riskiness and volatility of commodities is way too high to make it a core element in portfolios. So this got me to thinking, if bonds are a no-go in our new inflationary environment, what can investors hold that is decorrelated to commodities, reduces volatility, but doesn't have a negative expected real return in a stagflationary environment? That's where a left field asset might make some sense. What is a large non-dollar issuer of sovereign debt that has a lot of commodities, makes stuff the world needs, and has a favorable credit rating? China. I know, I did touch on issues in Chinese real estate in a prior episode, link in the description below, but things have changed in just the past month. I can recommend a recent Grant Williams podcast with Luke Groman as a guest, who gave rise to the idea that the US response to Russian aggression to sanction Russian dollar reserves is actually the starting gun of a large economic restructuring that will lead to a weaker dollar and a strong renminbi, which will continue its reorientation away from a managed float regime versus the US dollar to a managed float relative to harder assets in gold and oil terms. It is an involved argument, and I won't do it justice here, but I will put a link in the description box below. Ultimately, RMB bonds look like the least worst duration available at the moment, with a yield of over 3% and bond-like volatility of 4 to 5%. Here are some charts on recent steady eddy yields and performance. It looks much unlike other things available. VanEck runs the largest local China bond ETF, ticker CBON, and it was also the first launched in 2014 as China opened its bond markets to foreigners for the first time. There's plenty more marketing bump on the VanEck website, including extensive risk factors, and I'll include another link in the description box below. One item stood out and it's worth highlighting here. Only 3% of $17.4 trillion in local Chinese debt outstanding is currently owned by foreigners, and it is just now being added to global debt benchmarks. So demand is expected to rise from passive investors, if nothing else. So we have a suitable exotic asset in CBON. How does the computer want to allocate when facing an extreme 73 to 74 scenario? 60% in CBON and 40% in commodities. An inverted 60-40 for the 70s, if you'll allow the numerical alliteration. Expected return is 4% at 8% volatility, a princely reward versus the minus 11% at 12% volatility expected from the stalwart 60-40. The to be forewarned is to be forearmed. And that is all from me today on Money Managers, a User's Guide. If you found this content interesting, please like, comment, share, subscribe, and hit the bell for notification of future episodes. And remember, Use your money managers. Don't let them use you. Thanks. Now I'm going to get out of the rain.